Hi, welcome to another episode of 2 Minutes on Tuesday. I am Sam Miller of RE/MAX Stars Realty. I'll get this in 3 minutes or less, I promise. So first, housing market, super robust, tremendous activity. And the best news is we have more houses available on the market today than I've probably seen in the last 6 months. And that's really very beneficial for buyers. Obviously, they have more choices. And it's also super beneficial for sellers because most sellers in the market, they're like, I want to sell my house, but where am I going to go when I sell it? And there were some people that were fearful that their house would sell so fast they could actually sell themselves out on the street and not have a replacement home. So now that there are more houses for sale, there's more options for someone who wants to sell their current house when they sell it to have a place to buy and move into. So great for buyers, great for sellers, especially those who are going to become buyers again. And so that's primary thing I wanted to mention. So we got great inventory coming, more listings around the corner as well. Something, and those of you who follow this channel a while have heard a part of this story, so you'll recognize where I'm headed with it. I've been selling real estate for 35 years, and when I got in the real estate business in 1986, the interest rates were around 11.5%. So a $100,000 home loan at 11.5% was about $990 a month. Today, the interest rates, we closed a loan last night and the interest rate was 2.875. So when I show you this, you're not going to believe it. You're going to think it's a typo, but it's not. So 35 years ago, a $100,000 loan, 11.5%, $990 a month. Today, a $100,000 loan at 2.8%, 30-year, $414. That monthly payment is less than half for the exact same loan amount, which is significant. So when someone says, I'm thinking about buying, but I think I'm going to wait for the pricing to go down, the factor that I think a lot of them aren't considering is what's driving the current market and driving the pricing up is the low interest rates. That makes the house affordable. But if we have a shift in the economy and the rates go up and the price of homes go down, you could have a higher monthly payment just even at a lesser price. Say the house drops $30,000, but the rate goes up 2%. What you pay on a monthly basis for that higher interest rate, you'd have a higher payment at $30,000 less than you would if you bought it today for $30,000 more, but having a much lower interest rate. So I'll give you an example, and here's a great one. I gave you that example, $100,000 35 years ago, 11.5% at $990. To have a payment at $990 today at 2.875, you're going to be able to get a $238,000 loan, and it's the exact same thing, about the exact same term, same payment, just difference in interest rate, and you qualify for a whole lot more money. And again, that's what's driving the current housing market. You buy the house and pay the price of the home once, but your affordability is your monthly payment over the life of the loan. And most people would love to have a nicer home at a lower payment than a lesser value home with a higher payment. I mean, I don't know anyone that would rather have a lesser house and have to pay more for it. And again, that's a big part of what's driving this economy for real estate. But more than that, if you have a lower monthly payment, it's easier for you to qualify to get a loan based on that lower monthly payment. The higher that house payment is, the harder it is for a buyer to qualify for the loan guidelines to get that loan. So right now, even though pricing is up, since it's up, the interest rates are down, you're actually saving money on a monthly payment for the life of the loan. So, and I don't think rates are going to stay low forever. So anyway, I'm Sam Miller, RE/MAX Stars Realty. Got questions? Feel free to call us, 740-397-7800. Talk to you later. Till next week. Bye.